Welcome back, everyone. In Chapter 1, we talked about the foundations of accounting, financial statements, and the accounting equation. Now, in Chapter 2, we'll learn how the accounting process actually works, from recording a transaction to preparing a trial balance. Our learning goals today: 1. Understand assets, liabilities, and equity, and how debits and credits affect them. 2. Analyze transactions using double-entry accounting. 3. Prepare a trial balance. 4. Record transactions in a journal and ledger. 5. Explain the accounting cycle. Let's dive in. Let's start with the building blocks. Accounts. An account is a record that tracks increases and decreases in specific items, like cash, accounts payable, or owner's equity. Think of each account like a separate folder in a filing cabinet. There are three main categories: assets, what the business owns; cash, equipment, inventory; liabilities, what the business owes; loans, accounts payable; equity, the owner's interest after debts are paid. Sir, how do debits and credits affect these? Good question. Remember this simple rule. Account type: debit increase, credit increase. Assets: increase with debit, decrease with credit. Liabilities: decrease with debit, increase with credit. Equity: decrease with debit, increase with credit. Example: if the business buys equipment for cash, equipment, an asset, goes up. Debit equipment, cash, an asset, goes down. Credit cash. Now let's use double-entry accounting. Every transaction affects at least two accounts and keeps the equation balanced. Example 1. The owner invests $10,000 cash in the business. Debit cash, $10,000. Asset cease. Credit owner's equity, $10,000. Equity. Example 2. The company buys supplies worth $2,000 on credit. Debit supplies, $2,000. Asset E. Credit accounts payable, $2,000. Liability E. After recording transactions, we check our work with a trial balance. It's a list of all accounts and their balances at a specific date to ensure total debits equal total credits. Example: account, debit, credit. Cash, $8,000. Supplies, $2,000. Accounts payable, $2,000. Owner's equity, $8,000. Totals, $10,000, $10,000.
Sir, if the trial balance totals match, does that mean no mistakes?
Not necessarily. It only proves the math is correct, not that all entries were made in the right accounts. Now let's move from analyzing to recording. We use two main tools. 1. General Journal, the book of original entry where transactions are recorded chronologically. Example: debit cash, $10,000. Credit owner's equity, $10,000. 2. General Ledger, the book of final entry where each account's total activity is summarized.
So the journal is like a diary and the ledger is like organized files?
Exactly. The ledger groups all entries by account for easy reference. Finally, let's see how it all connects. The accounting cycle. Steps: 1. Analyze transactions. 2. Record in the journal. 3. Post to the ledger. 4. Prepare a trial balance. 5. Adjust entries. 6. Prepare adjusted trial balance. 7. Create financial statements. 8. Close the accounts. Example: at the end of each month, a small business follows these steps to prepare its income statement and balance sheet.
So this cycle repeats every month or year?
Yes, it's a continuous process for every accounting period. Let's recap what we've learned today. how debits and credits affect assets, liabilities, and equity. How double-entry accounting keeps everything in balance. How to prepare and interpret a trial balance. How transactions move from the journal to the ledger. And how the accounting cycle brings it all together. Now, it's your turn. Try these quick exercises. 1. Record an owner investment of $5,000 cash. 2. Buy $1,000 supplies on credit. 3. Prepare a simple trial balance from those transactions. We'll balance the debits and credits ourselves, right? Exactly. Practice makes perfect. Once you master this, you'll understand how every financial statement is built. Great work, everyone. You now understand the heartbeat of accounting, the process that turns transactions into financial information. In our next chapter, we'll look at adjusting entries and how they help prepare accurate financial statements.